In less than 1 year, I was able to purchase my first rental property where I optimized the building by improving the living conditions and subsequently raising the rent to then be able to turn around and sell the property for roughly a 400% return on investment. And I want to show you exactly how this was achieved and what you can do in order to replicate these results with little money down. Hey, what's going on, savers and investors? I hope you're all having a great day as always. If you're new to this channel, then welcome. My name's Griffin, and on this channel, we speak about all things investing, from specific company analysis, stock market news, and real estate. So if you're looking to grow your wealth through investing, make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. I am super pumped for today's video because we're going to be covering some extremely valuable information about my entire first real estate transaction that I honestly wish I had access to when I was just starting out myself. So hopefully this video can give you some perspective on what's really possible with real estate investing, even when you're just starting out with a small amount of capital. If you've been around the channel for a while, then you're definitely aware of the fact that I always try to be as transparent as possible with the audience through my videos, where I share my thoughts, opinions, and experiences around different investing topics. And hopefully these videos can help motivate and guide you towards your own financial success. Now, I haven't made a video on real estate investing in a while because the reality is that real estate transactions do take quite a bit more time and effort than just opening up your Wealthsimple trade account and buying some shares of Well Health. But nonetheless, I am still actively looking to include real estate in my portfolio and overall investing strategy, and I would highly recommend that you look to do the same thing as well. Even if this is something that might be a couple years out, you should be looking to include rental properties in your overall investment portfolio other than just your primary residence as your only piece of real estate. Okay, so back when I made my first video about this particular property, it was around August or September of last year, and in that video we broke down all the numbers related to the acquisition of that property, including the actual purchase price, the taxes, monthly running costs, etc. So in this video we are going to be just revisiting those initial costs and running costs of that property to refresh our memories, and then we'll be speaking about why I was able to create a relatively high return on investment on this property in such a short period of time. This is how this video will be broken down. So we're going to start off with the initial numbers of purchasing the property in question, and then following that we'll be speaking about what was done to the property in order to raise the rent of each unit, followed by the new multiples on the property, and then finally we'll be ending this video with the final sale price and fees related to the sale, and then the return on investment as a result. The first thing we need to cover in order to properly calculate the overall return on investment of this property is the initial cost of the property that were out of pocket when I first purchased this, so let's cover those right now. The property itself was a duplex located in Hull, which is a very central location on the Quebec side of the National Capital Region, so very close to Ottawa as well as multiple post-secondary institutions. So this was really a central location that could appeal to a variety of different tenants. The duplex was purchased for $182,000 just 1 year ago, and for this reason, on a 5% down payment, this equates to only $9,100, and this is really the main reason as to why the return on investment was so high considering the short-term holding period of the property. Now, if this is one of the first times that you watch a video related to real estate investing, you might not be aware of this, but if you put less than 20% down payment on the purchase price of the property you're looking to buy, you need to get what's known as mortgage insurance. And mortgage insurance is essentially a percentage of the total mortgage loan value that you're taking out on this property, and the insurance rate will vary depending on if you put 5, 10, or 15% down on the property. The table that I'm overlaying right here showcases what percentage of your total mortgage loan is going to be added to the mortgage in order to create a new total mortgage value. So in my case, since I only put 5% down on the property, an extra 4% in mortgage insurance was added to the entire total mortgage amount in order to give me a new combined mortgage of the initial mortgage, including the mortgage insurance premium. With a down payment of $9,100, this left an initial mortgage of $172,900 to be taken out on the property, and then added to this is that 4% mortgage insurance, which equates to $6,910. And remember that mortgage insurance value is then added back on to the initial mortgage, and then all of it is amortized over the term of your mortgage. In my case, this was 25 years, so in this case, the new total combined mortgage was around $179,910. And remember that the mortgage insurance value is then combined to your initial mortgage, all of which which is then amortized over the period of your mortgage. In my case, this was 25 years and will most likely be 25 years for you as well. But all of this combined created a new total mortgage for me of $179,816. At this point, you may notice that this new mortgage value is almost the same as the actual purchase price of the property, which in this case was $182,000. And for some people, this is one of the main reasons why they don't see mortgage insurance as being a viable option that makes fiscal sense. However, the way that I see this is that for almost $10,000 down, essentially, yes, I have to take on this mortgage insurance of $6,900 roughly, but it's amortized over 25 years anyways, and I then get access right now to essentially a $200,000 asset in the market. Now, we do have some other closing costs that we'll be rifling off right now in order to determine the total out-of-pocket cost to purchase this duplex initially. First off, when you do get mortgage insurance, you actually have to pay a tax on top of this as if you were purchasing the mortgage insurance. So this is going to vary depending on the province that you live in, but in my case in Quebec, this equates to 9% of the value of the mortgage insurance. So 9% of $6,916 is roughly $622 that I had to pay at the notary on the day of closing. There was then the notary fee of around $1,500, followed by the land transfer tax, also commonly known as the welcome tax, and this was roughly $1,800 for that property, and then finally an inspection was done for right around $500. All of this combined creates a total initial out-of-pocket to purchase this duplex of roughly $13,522. I do want to mention at this point that $182,000 to purchase a rental property, yes, I'm well aware of the fact that this is very inexpensive. In fact, this happened to be the cheapest duplex sold in the entire region that I live in during the 2019 calendar year. However, even though real estate might be more expensive in your market, don't let that be a limiting factor where you're just shutting the door right away to real estate investing in general just because it's more expensive. It might take more time in order to save up in order to purchase a rental property. However, I still think that it's very important to include multiple different asset classes in your overall portfolio instead of just right out the gate telling yourself that real estate investing is not something that's doable for you due to your market. Okay, we now know that it costs roughly $13,522 out of pocket in order to purchase this duplex, and we're going to be revisiting this figure at the end of the video when calculating the return on investment on this real estate transaction. From here, the duplex is purchased, and now all the responsibilities, including rent collection and paying for the expenses and property maintenance, are my responsibility. So let's go ahead and speak about the expenses of this property. Starting with the largest monthly cost if you do take out a mortgage on the property, well, it is going to be the mortgage, and this payment also includes that amortized mortgage insurance premium that is added to the total mortgage. As you can see on the screen right here, at a total mortgage amount of $179,816 amortized over 25 years at a 2.74% interest rate, we're looking at a monthly mortgage payment of, let's just round it up, to $829. And by the way, the reason why in this mortgage calculator I put the total combined amount of $179,816 in the actual purchase price is because we already took into account the down payment here as well as adding back on the mortgage insurance. So this is basically just calculating how much the monthly cost would be on amortizing this loan over 25 years. And this monthly amount right here of $829 includes the interest and the capital pay down all in one payment. From here, there was also building insurance at $134 per month, as well as municipal taxes at $189 per month. All other expenses that you could incur, such as snow removal, grass cutting, etc., was taken on by the tenants. This brings the total monthly fixed cost of this building to $1,152. Now, what about the actual income that this property was generating? Because at $182,000 purchase price, the revenues mustn't have been too stellar. Well, it turns out that they weren't. Each unit was generating $675 per month for a total combined of $1,350 in monthly income for this property, which did, however, cover all the monthly expenses. So right at the gate, this property was still cash flowing at only 5% down and under market rents. This is the reason why, to me, paying mortgage insurance isn't an issue if you're getting a good deal on your rental property, because at the end of the day, even if you're paying a little bit more per month, well, this property is cash flowing anyways, and I now have access to controlling a $200,000 asset in the market that I can take advantage of in multiple different ways, as we're going to be speaking of right now. Now, obviously, to raise the value of the property through forced appreciation and raising the rent, renovating renovations had to be done. We changed the 2 exterior doors, repainted the entire interior, changed doorknobs, fixed broken windows, as well as replaced some drywall that was broken, and replaced the entire flooring in the place, and then finally we repainted the entire exterior. All of these renovations cost right around $2,500 because they were done by ourselves, and actually the previous owner had got a quote for doing all this work by a general contractor, and he had quoted him $4,400 to do all of this work. So on the day of closing, the previous owner gave us $4,400 cash, and that was just included in the deal. So essentially we were paid in order to do those renovations anyways. So this is the reason why I did not include these renovations in the initial out-of-pocket expenses to purchase this property. At this point, with a renovated interior, the rent for each unit went immediately up to $800 a piece for $1,600 in monthly income, and equating to $19,200 per year in gross income of this duplex. And this actually put the monthly cash flow at right around $450. Okay, so we just went through a lot of financial numbers. However, hopefully this can give you some further insight into the initial out-of-pocket costs that you would incur when purchasing a property, as well as some of the running fixed and variable costs of your property. At this point, $450 per month in cash flow, which was great, and the building was stabilized, so there was no real thought at the time of selling the property. However, months later, an undervalued fourplex came up on the market that would require additional capital in order to invest in, and I saw this deal as another opportunity for some forced appreciation. So this is one of the reasons why, in real estate, you need capital in order to roll into new deals and stuff. So this is one of the reasons why I decided that maybe selling the property would be a good option. And at the same time, the overall real estate market in this region completely blew up. After consultation with my real estate agent, we determined that the sale of this duplex could provide some nice upside for me that I could roll into another deal, even if we priced the duplex at one of the cheapest price points in the entire region, making it both attractive to me as well as a potential new investor who's just getting into real estate, which was really the end case. So that's exactly what happened. We listed the duplex for $250,000, and within 2 to 3 days, we got an offer that was accepted at $247,000, which is around $65,000 above what was paid for it just a year ago. We're now going to be diving into the closing costs of this property and what was left over after all was said and done and paid up, in order to calculate the final return on investment of this duplex. And if you're enjoying this video and the level of transparency that I'm providing, please take 2 seconds to drop a like on this video. That's all I ask in return, and it really helps my channel grow. Alright, so $65,000 in my pocket. We're calling it a day. I went straight to the dealership and bought a brand new car. No, not exactly. At this point, when you close on a property, there are still some more fees that you need to take into account. It never seems to end with fees. These include the agent's commission, as well as more notary fees, fees for breaking a fixed mortgage, and then finally, the government will always get their part in capital gains taxes. Let's start off with the agent's commission, and on the right of the screen, we're going to be deducting each one of these costs as we go along. In this particular case, at a sale price of $247,000, the agent's commission on the transaction was right around $9,900. Then from there, we have more notary fees, and in this case, it was right around $1,200 for the sale of the property. After that, we have a big one, and this is a fee associated with breaking a fixed mortgage term, and I was not aware of this when I first purchased that property about a year ago, so hopefully you can learn from my mistakes here. Basically, if you break a fixed mortgage term by either selling the property or refinancing the property with a different lender than your current mortgage, you're going to have to pay a penalty, which can be anywhere from around 3 to 5% of the mortgage loan. In my case, since the property was literally only purchased less than a year ago, the mortgage penalty here was absolutely huge for breaking that mortgage contract at right around $7,700. However, on the flip side, had this been a variable mortgage, the penalty would have only been 2 to 3 months-ish of interest on those payments, so it would have been around $1,200. But here's the thing, I did not have to pay that $7,700 fee for breaking this fixed term mortgage, because I'm going to be porting over that mortgage into a fourplex that I've mentioned on the channel before, and we'll be making a full comprehensive video about that once it's all closed up. Essentially, what porting over a mortgage to another property means is that you're literally just taking your current initial mortgage and placing it into the new property, and if there's a balance or excess left over, you take out a second loan which is going to cover the excess portion, and that's exactly what I've done on this fourplex. There's a couple loose ends here and there that I'm not going to take into account for this overall calculation of return on investment for this property and expenses associated with closing the property. However, essentially here $53,900 came back to me after selling this property, and then from here you also tack on the down payment that you recoup as well as the built equity from paying down your loan each and every month. In this case, over the roughly 10 months of property ownership, $4,200 was built in equity from paying down the loan each month, and then from the down payment of $9,100, only around $2,600 actually came back to me when I sold the property, when you take into account the mortgage insurance that was tacked on to that initial mortgage. All in all, this means that after 10 months of ownership, right around $60,280 came back to me from this investment. Now from this $60,000 though, I'm not going to take into account the down payment of $9,100 in the return on investment, because that $9,100 is actually the money that I put down on the property as the investment. However, I will take into account the 10 months of cash flow at $450 per month for a total of $4,500 added on to that return. I hope that makes sense. So we'll subtract from that the $9,100 and then add back on the $4,500 in cash flow, leaving us with a total figure of $57,680. I honestly wish we could end the video here. However, I would not be doing it justice if we didn't speak about taxes. Unfortunately, in Canada, we do not have a variation of the 1031 exchange like down in the United States, where essentially with a 1031 exchange, you can sell a property, and then if you buy a larger property within 90 days, you can defer taxes to a later date. We don't have that here in Canada, so I did have to pay capital gains taxes on that amount that I gained on this investment. And I really don't want to turn this into a taxation video, but in Canada, the way this works is that for capital gains, you pay those capital gains taxes on only 50% of the gain in question at your marginal tax rate, so it's going to differ for every individual. Do note, however, that the cash flow that you're generating from your properties will be taxed as personal income tax instead of as a capital gain. However, for the sake of this video, and I'm not going to get into my own personal tax stuff, but essentially I paid around $6,700 in capital gains tax on this transaction. And this is the final expense that we have to subtract from the overall value, so we're left now with $50,980. And FYI here, this is not a fully accurate calculation, so when you're doing this for yourself, make sure to consult your accountant. We're now at the fun part of this video though, where we can calculate the final ROI on this transaction by dividing $50,980 by the initial total out of pocket, which was $13,522. This produces a final return on investment after all expenses and taxes are paid of right around 377%. If I would have calculated this ROI before taking into account the capital gains taxes, this would have been around 427% ROI. I definitely think that this is a good investment return for my first duplex. With all that said, the reason why I chose to make this video today, which definitely differs from my typical type of content, is because I really just wanted to share my overall experience with you of both buying and selling a property, so that hopefully you can take this information and know what to expect when purchasing your own first rental property, and really just what's possible with a little amount of capital when just starting out, which for a lot of new investors can be a limiting factor in their mind. Obviously, keep in mind here that every single real estate transaction is going to be entirely different from income and expenses and return on investment that you can expect, because there's just so many variables. But hopefully this video gave you some further insight into the different expenses that you're going to incur when purchasing and managing a rental property. I'll also be making a video on that fourplex that I know I spoke about quite a while ago on the channel, but it's taken significantly more time due to that whole mortgage porting situation, and right now due to the backlogs in banks, everything is taking a lot longer. But let me know down in the comments if you'd be interested in seeing that video. I really hope you enjoyed this transparent video on the entirety of my first real estate transaction. If you did, please take 2 seconds to drop a like on the video. It really helps my channel out. Now, if you want to learn more about investing from stock market as well as real estate investing, make sure to subscribe to the channel and hit the bell button so that you're notified whenever I release new content. On that note, thanks a lot for watching today's video, and I'll see you in the next one.